What if I told you that company can look amazing on paper, make great sales, report great revenue, and even report profit, and still be weak where it really matters? That's why today we're talking about free cash flow, one of the most important numbers in the investing. Revenue can look impressive, profit can look impressive, but neither one tells the full story. If you really want to know whether a company is strong, you need to look at the free cash flow. Today we'll talk about what is free cash flow, why revenue is not enough, why net income is not enough, free cash flow formula, real company example, why it is better than just looking at sales. Just a quick reminder, revenue is not profit and profit is not cash. So, what is free cash flow? It is the cash a company has left after pays the cost of running the business and the money it needs to reinvest to keep growing. It has multiple expenses, and what's left is the free cash flow. Let's make it super easy with a candy shop. Imagine I sell candies and make 1000 in sales. That is my revenue, but I still have to pay for ingredients, for rent, for employees, delivery, and make even new machine. So free cash flow is what's left. It's $250. If I have 250 left after all that, that 250 is basically my free cash flow. That is the cash I can keep, save, invest, or use to grow the business. So the important idea is not just how much money comes in, it is how much cash is left after the business takes care of itself. Let's talk now why revenue is not enough. Revenue only tells you how much money came in, it does not tell you how much money was left. A company can have huge revenue and it still be weak if its costs are too high or if it needs to spend too much just to stay alive. That's why investors cannot stop at revenue itself. Revenue is the starting point, not the final answer. So why net income is not enough? Net income is useful, but it still does not tell the whole story. Net income includes accounting rules and non-cash items, so it can make a company look better or worse than its actual cash situation. That is why free cash flow is often better for investors. It focuses on real cash, not just accounting profits. Here is the simple formula. Cash flow from operations minus capital expenditures equals free cash flow. Cash flow from operations is the cash the business generates from its normal activities. Capital expenditures or capex are money spent on things like equipment, servers, buildings, or technology that keep the business running and growing. So free cash flow is what is left after the company runs the business and reinvests in the business. Companies can use free cash flow to pay debt, buy back shares, pay dividends, invest into the growth, or survive a bad year. Company with a strong free cash flow has options, and in investing, options are power. Take Apple as an example. Apple is one of the best examples of company that generates massive free cash flow. That means after Apple pays for what it needs to run and grow, it still keeps a huge amount of cash. That is a big reason why investors pay so much attention to it. Now, here's another useful metric, price to free cash flow. It tells us how much investors are paying for each dollar in free cash flow. Here are two simple formulas how to calculate price to free cash flow. We can take a stock price divided free cash flow per share, or we can take a market cap of the company and divide it total free cash flow. Current price to free cash flow of Apple is 26.75. It's a little bit higher than median of the market in this niche. That means investors are paying about $26 for every dollar of Apple's free cash flow. And if the average company in Apple's sector trades at lower price to free cash flow, then Apple is being valued at premium. That usually means the market expects stronger growth, stronger cash generation, or both. So Apple is not just cash generating machine. It is also a company that market is willing to pay extra for. So overall, we can say that Apple is a little bit overpriced now. Why free cash flow is better than just looking at sales? Think about it this way. If company has huge revenue but very little free cash flow, that is not as attractive as company that consistently turns sales into real cash. As example, we can take Peloton and we can take a look into revenue and free cash flow. We see that free cash flow is very often negative, sometimes it's a little bit positive. But if we will take a look into Adobe, for example, we see that revenue is consistently growing. Same is for the free cash flow. Of course, free cash flow is growing a little bit slower, but still it's much better situation if we will take a look into the Peloton. So when you analyze a company, ask these questions. Does the company make cash? Does it keep cash after spending? Can it grow without constantly needing outside money? If the answer is yes, the company may be financially strong. If the answer is no, then the business may look good on the surface but be weak underneath. So here's the simple version. Revenue tells you how much came in, net income tells you the accounting profit, but free cash flow tells you how much real cash is left. Thank you for staying until the end. It really helps me a lot. And if you enjoyed this content, please like, subscribe, and leave a comment. It will help me a lot. Thank you.